If you really get the hang of these two inducement types, you can leave the fear of stop loss hands behind. Pair them with your trading strategy and you will just see an improvement. Your win rate will explode. It almost feels like unlocking a cheat code in the market. Let's break down the first inducement type. Picture this. You see multiple strong victor candles or Mariposa candles charging in the same direction, looking super bullish or super bearish. It's aggressive and it catches your eye. You just want to jump in and follow the momentum. That's exactly what the market wants you to do. Lots of traders get tempted to buy or sell right then, only to watch the price whip the other way in an instant. Usually, everyone is left in shock, wondering how they got caught out so badly. So, what's really going on here? These moves are often designed to grab liquidity that's sitting above equal highs or below equal lows, or maybe even right at some well-watched trend line liquidity. The smart money runs the price to those spots, triggers waterfall of stop losses or breakout orders, and then, bam, reverses direction. How do you know when this game is over? Here's what you look for. Once the market's taken out that obvious liquidity, like those equal highs and lows or a stretched trend line, and then reacts at a point of interest, maybe a supply or a demand zone, right above or below those liquidity pools. That's your cue. The inducement phase has played out and the market's ready to start its rear move. So if you can spot this setup, you will stay ahead of those painful fake and head fakes that trip up so many traders. It takes practice to watch for liquidity grabs and see when price hits those point of interest. But once you do, it feels like dodging traps while everyone else is still walking straight into them. Let's talk about the second type of inducement, which is liquidity sweeps. This one's actually pretty straightforward. Once you get the hang of it, picture a strong wick that quickly pushes beyond a recent high or low on something like the 4-hour or daily candle. That wick isn't just random noise, it's the market grabbing liquidity above or below those obvious levels, the candle high or low. Now, once you spot that sweep on the higher time frame, that's your cue. Head over to 5 minute or even the 1 minute chart and watch how price action unfolds around that area. Usually, that's where you'll see some of the best setups. You can catch price snapping back after the sweep, making the price incredibly clear. Honestly, if you get comfortable identifying these liquidity sweeps, you won't second guess your buys anymore. You'll always know which side to lean on, and you won't get thrown off by fake breakouts or random volatility. Let me walk you through a real example to show you exactly how this plays out in action. On 4 hour, we have a sweep here as you can see. Now, we need to place a vertical line on the next candle like this. We want to know when did this candle close. So let's go on 5 minutes. As you can see, the sweep happened over here. Here's our sweep, and the candle that swept this high, the previous 4 hour candle high, closed over here. Now we can look for a trade around here. As you can see, price created fair value gap from here till here. We can set limit order like this, stop loss above this high, and take profit 1 to 3, something like this. You can even go to 4 hour and look for fair value gap to target as take profit. We need to look to the left. We have here, as you can see, a fair value gap, a huge one, huge fair value gap, as you can see. We will set take profit in the middle. The middle was mitigated. We will probably set at the beginning, let's say somewhere around here, like this. So that's it. If you got any value, make sure to like this video and comment down below if you have implemented these two types of inducement. See you in the next video.